everyone, and welcome out to your Maverick Currencies midweek for April 5th, 2023. Corey here with you. Nice to see all of you out here today, and let's jump into it. So, a few different things as we look at this week and what's been transpiring. So, bad news, but good price action for stocks. They continue to work their way higher. I've been on record the past couple of weeks saying I think the banking crisis, in terms of the major crisis portion of it, is simply over. Now, that doesn't mean there won't be ramifications. That doesn't mean that there won't be a general slowdown in bank lending. They're going to have to play it conservative. There are still side effects, but the actual crisis, the runs on the banks, the things that were causing all of that volatility, well, those have subsided. US dollars in a short term downward trend. I would call myself half right and half wrong. I certainly expected this is the same as we talked about last week. The safety trade is coming undone, so we expected US dollar weakness. What I got dead wrong was that I thought that that would also lead to precious metals, gold and silver and some of those things going down, and that has just not been the case. Gold and silver and those have gone higher. Now crypto's gone sideways, but as far as the safety trade, I certainly got the precious metals aspect of that dead wrong. But on the FX side, we did see US dollar come off. Now, interestingly enough, on Monday, I did the RBA meeting with all of you, and we talked about Aussie USD on the short side. So if we go back and review this, right in here is where we shorted, and it was a short-term trade, but certainly profitable, down to 67.50, down to the target from where we entered. I did advocate for taking off half of the trade, though, so you probably only had a half position size. So it wasn't a huge winner or anything like that, but you can see how Aussie USD has pushed to the downside overall. So from the standpoint of trading, we actually flip-flopped a little bit on our USD outlook and just played it against, basically, that the Aussie was worse than the US dollar. Let's put it that way on Monday going into that event. And if we skip down here as to why that's the case, the RBA kept rates unchanged at 3.6. The RBNZ continues to raise rates. And look at that interest rate differential. RBNZ has moved to 5.25. The RBA has only gone to 3.6. Now, usually those would be much closer together. This is basically Australia saying we're more worried about an economic slowdown and less concerned about deep-rooted inflation. New Zealand saying we're very worried about deep-rooted inflation. We're less worried about slowing the economy. So you've got central bankers on both sides of this, and it really depends ultimately on your outlook. There's a lot of economists that say, hey, the Fed's already done too much. There are other economists that are saying they've got to do more, in essence, that they've got to continue to push the interest rates up to basically get the markets going a little bit slower in pace, getting this inflation to come down. Now, some of the CPI, some of that inflation is going to come down organically. I've talked about that if you look at the annual CPI, and maybe it would be instructive to actually do that together. If we jump over to next week, now this is next week's calendar, and if we jump over to next week, it's actually a week from today, in fact. The CPI numbers are coming out in the US. Month over month is expected to grow by 0.4. The annual expected at 6%. Now, look at what's coming down the road, though. So if we pull up this graph and look at the CPI data, I guess we actually need this one. We want the month over month numbers. Because what I want to point out is where you're going to get rid of some big, huge CPI numbers. If you look at this, an annual CPI is just adding up all of the inflation numbers for the prior 12 months, right? And that gives you an annualized number. Now you can see the downward trend. Why is it downward trending? Well, because in essence, we're getting rid of higher inflation numbers and adding lower inflation numbers. So if you just look at the barrier here, look at where 2023 started, look at where it began, look at where 2022 started and where it began. The January number was higher than here, there versus there. The February number, we put in a lower number than 2022. The March number, we put in a lower number than 2022. And look at what April, if April comes in at 0.4 right here, look at what we start to get rid of over the next couple of months. These are numbers where your monthly number was inflation running hot at 1.1, 1.2, 1, these are big inflation numbers. And these are going to fall off over the next couple of months, and we're going to be putting in lower bars, right? So think about the reduction as you start to get rid of a 1.2, and maybe the inflation for that month comes in at 0.3 or something, or 0.2, let's make the math simple. You get a full 1% drop in the annualized inflation number. So some of those inflation numbers are coming down organically in that you're just getting rid of high levels of inflation, which happened in the spring, going into the summer of last year, and we're going to be putting in lower inflation numbers coming up. And so that's something that, again, you've got to be prepared for, in essence, that basically this 6%, we know it's not even really a question. Is the inflation going to continue to come down? Well, it's a math equation that's pretty simple. Unless somehow the inflation goes bonkers over the next couple of months, it doesn't seem like that's likely. Unless it goes bonkers, these inflation numbers are guaranteed to come down as you get rid of some of those. Now, here's the problem, and this is what I've talked about for months now, is even with that happening, you're probably going to start sustaining more of like a 4%, 2% over, double the Fed's target and their mandate for keeping price stable, right? Not letting inflation get out of control. They completely destroyed all credibility, in essence, as they called inflation transitory, and then it just blew up in their face. So what the Fed has to do, I use this analogy of golf. If you just stepped up to the ball and you have 100 yards to the pin, but there's water in front, and you just dumped one in the water, what do you have to do the next swing? Well, you have to make sure you clear the water, right? You probably hit the next one long, just because you've got to make sure that you give yourself that distance. That's where the Fed is at. They screwed up inflation, basically let it go too high right here. So what do they have to do? They have to err on the side of forcing it down. If in doubt, they have to be hawks, not doves. They have to raise rates when in doubt. Basically keep rates up, raise rates. They are not able to slash them unless the evidence is just overwhelming. Now, part of the evidence is certainly coming in that the economy is slowing down. Look at the PMI numbers that came out this week. 47.5 down to 46.3. Anything sub 50 is a declining, basically a recessionary number, where the manufacturing numbers are in recession, sub 50. Look at the services PMI, a huge miss this morning. 54.3 expected 51.2. So the economy seems to be slowing pretty aggressively, which again gets back to that argument that the Fed has probably already done a lot that's going to take some time to come through, and that inflation's coming down. The market's already trying to get out ahead of that and say, well, maybe they're going to start moving towards, cutting rates later this year and so on. I think they're maybe jumping the gun a bit on that. So as we look at this week, the S&P and the international markets are giving a little bit back. We've been on such a nice run. We exploded higher last week, and we liked a risk-on scenario. We talked about it, that we thought risk-on would happen. We thought the safety trade would come undone. half right, half wrong. USD did come down a lot. Gold, silver certainly did not. So now the S&P pulling back slightly. Crypto's up, gold up. Oil's a big story. Oil is up big on OPEC cutting production. I don't know what the U.S. is doing. The U.S. had an opportunity to really hit a home run with the Strategic Petroleum Reserve. They had been selling oil, and then oil prices went down. So it was like perfect scenario for them. And oil got down in the 60s. And they have not filled back up the Strategic Petroleum Reserve. So now oil's back at 80, and they haven't filled it up, and they don't have enough in storage to sell more, and they just missed. I don't know what they were doing. I don't know what they were thinking. I even made mention that they were probably the best oil trader out there because they happened to sell at great prices. Now they had a chance to buy. Well, they didn't buy. I have no idea what they're doing, what they're thinking. I suppose their thought process was if we start buying, it's going to push oil back up. So let's just not buy and it'll stay down. Uh, not going to work if oil doesn't stay down. And why do they think that it had to stay down? I don't get it. I don't understand it. They had a perfect opportunity to really do some good things there. They had driven oil lower. They had helped that situation, and then they simply fell asleep at the wheel. So it may be a situation. My guess is in these types of circumstances, there's pain for those that missed the boat. A lot of people thinking that they would buy down there, and now all of a sudden, if you start seeing oil get to 90 and 100, and the U.S. has tapped already their strategic reserve, and they have to start buying at higher prices, or they just don't fill it back up. Again, I don't know what the thought process was there, but I'm not going to call them the best oil traders anymore. They really screwed that one up as well. So uh, take it for what it's worth. They had a golden opportunity and they missed it. The S&P coming back to the prior breakout zone here. This looks like an orderly pullback for the most part. You would expect some give back. Stocks, assets, currencies, they tend to move in zigzags. So you had been on a big run. Of course, you can give a little back. We'll see if they buy the dip. If this selling intensifies and we start to break down and so forth, maybe that's all it had. As we look at currencies, like we talked about, we really liked USD to the downside, as we talked about last week in the midweek, but we actually flipped the script and had a nice little trade there in Aussie USD on Monday. Bitcoin, Ethereum, some of these others, basically flat-ish on the week, and we'll look at some charts here. So let's jump over and pull up some charts together. Actually, before we do that, let me look at a couple more charts here. So as we look at these charts, the international markets I wanted to take a glance at, very similar to US, and then a little bit of a pullback. Prior breakout zone at 50 period moving average. This seems like we'll probably go a little bit lower in all of these markets in the very short term. As you look at crypto, like we talked about, sideways, just consolidating, but credit where credit is due. This is more of a bullish price pattern than anything else. You can see the tight consolidation, the rising lows. Forget about the name and just look at the chart and say, would you be bullish, bearish, or neutral? Just based on the chart, you would be bullish on a price pattern like that. So looking at the rest of this week, we have a weird week. The equity markets are closed on Friday, but currencies, of course, will continue to trade. It's very strange to have a payrolls number on a Friday when the market is closed. That is rarefied air. Usually they don't do that. So equity markets the futures and things like that may move quite a bit. There may be quite a big gap on Monday, just given if there's any surprises or anything like that. But we're going to be trading, of course, the payrolls number on Friday morning. That makes me even more excited, more inclined to look for a trade on Friday as kind of a hedge against the equity markets being closed as well, in case there's a big event, a big number that starts to happen there. So let's come over now and let's take a look at some charts together. So again, as we come over and take a look at some of these, you've got Bitcoin in that ascending triangle pattern. I'm not a, I've missed the boat really in terms of not trusting crypto here. We talked about how ultimately the banking crisis was like the best case scenario for gold, silver, Bitcoin. So I'm not surprised they've rallied nicely. But in fact, you'd have to play them to rally. That's like the perfect recipe for them going higher. And it was an unknown unknown, right? The banking crisis was unplanned, unscheduled. So we know there were going to be reactions. Ultimately, is it done? Again, I think you'd have to look at this as more bullish than bearish. But I would still prefer, I've talked about, I'd prefer buying gold and silver to Bitcoin on a relative basis. Although I thought that gold had a little exhaustion high here that would come back in, and it really only consolidated for a few days and then took another leg higher. So I'd call myself certainly wrong about that outlook over the past week. We liked USD to go down. It's given back the key 104 level. The more the dollar trends down, the better it is for things like crypto and gold and things like that as well. But I was looking at them in the same basket, looking at them as basically an anti-bank, anti-Fed, anti-money printing type of idea, where basically as that safety trade came off, you'd expect that there would be a little bit of a that move out of risk off assets. Well, that happened in USD. Again, didn't happen in those other markets. Let's look at a few of these other currency pairs. So the yen held at the 50 MA. It's not a real clean picture, but certainly as we look at the yen on this chart, you've got a clear channel here in terms of the lower end of the range where we broke out from at the end of last year, and the upper end of the range, which is more clear as to where resistance is. So Japanese yen is dead smack in the middle. I would still expect that longer term the yen can go up and through there, but hard to be too confident about anything right in here. Euro continues to act really pretty well against most currencies, just sort of in a high basing pattern up there. Swiss franc, we expected that to again kind of give back a little bit, and all it's done is go sideways. So they haven't really rushed out of anything other than the US dollar. Pound continues to work its way higher. CAD and Kiwi and Aussie, those ones are kind of tough. CAD's jumped up, and this move in oil should be kind of a help, but ultimately I would prefer it to buying these, which would be my main focus. The Aussie is clearly the weakest currency. That seems quite obvious and quite clear. That's why we shorted it on Monday on the RBA meeting, and that's been working out. And then Kiwi, where the Aussie is weak, Kiwi's a little stronger because they're raising rates. But I would prefer personally more of the CAD trade than the Kiwi trade. You're right up at the downtrend line on Kiwi. Sort of a false breakout where it surged up through there, and now it's giving back a lot of those gains. Now it could still work its way higher, but what do we say? From false moves come fast moves. So if this continues to fail here, let's say that we start to turn down tomorrow and so forth, I would expect more deterioration, more downside in Kiwi if this is in fact a false break above that 50 MA slash downtrend line. So if it doesn't recover back up here and really create that breakout in the next day, basically, If instead it pivots and starts to break this way, it looks like a really good short. So put Kiwi right at maybe the top of your list for things to watch here over the next day or so, and just watching how it interacts with this little attempted but failure to break out. So if we just sort of drag that trend line, something like this is kind of where it tried to break out, and that long upper shadow. Long upper shadows are often a marker for tops, and it certainly has one of those. So a little short-term top seems to be quite possible. And then obviously the first trade is down here to the bottom of the triangle pattern, and the next area would probably be even below that. So Kiwi is vulnerable to a big downside move. We'll check back in on that over the next coming hours and days, but I'm personally watching that one pretty close. Good question. What's your outlook for the payrolls number? So payrolls for me, it's a little bit interesting in terms of how these numbers come in and how you look at them, right? Last report, 300,000 jobs gained. This report expected to be 236,000. Is a good payrolls number good or bad for things? Well, this could be a case where you say bad news, meaning a lot fewer jobs hit to the unemployment rate. Let's say the unemployment rate ticks up to 3.7 and so forth. That's bad news, right? Bad for the economy, etc. But it could be good for risk. And this is the tricky part of markets, is why would that be something where you'd want to buy assets and put on risk and so on? Well, there's it's sort of like chess, right? You don't just look at the move in front of you. You have to look at what that leads to. Okay, well, if I move here, what are his potential moves? And if he does those, then where would I go from there? And where does this take the game, right? And so trading is a lot like that, where you can't say everything that's bad news leads to lower prices. Well, that's just way too simplified. That's just not how it works. If that were how it works, everyone could just turn on CNBC and everything that they say is bad news, well, you short it and you make $1 million and it's so easy and that's all you have. It doesn't work that way, right? And so what we have to think about is, well, is a bad number going to be cheered? Because what does that mean? Well, that means the Fed is less likely to raise. That means they're more likely to cut. That means that more basically accommodative policy, it's more dovish. It shows that some of what they're doing is working. If the average hourly earnings don't tick up as expected, then that's anti-inflationary, that deflationary, or basically inflation's coming down. And so anyway, you can look at it as certainly a possibility that bad news could be good for risk. Now, one would think, however, that that could fuel, if you think about the US dollar, the US dollar does better on hawk and does worse on dove, right? So why is the US dollar going down? What are they seeing? Well, they're pricing in some of this, some more dovishness out of the Fed, that interest rates are done going up, that basically that's why they were going up. US dollar was on a huge move because it was pricing in the future rate hikes, and all the hawkishness that was the Fed. Since the bank crisis, the US dollar has turned sharply because now it's pricing in a more dovish Fed. And oh, by the way, the Fed's balance sheet went from 897 trillion down to 8.3, and it took them over a year to get that much reduction in their balance sheet. When the banking crisis hit, they increased their balance sheet to 8.7. They offset something that took them over a year of hawkishness to reduce their balance sheet. 2/3 of that gone in a blink of an eye when the banking crisis hit. So are they quick to still step in and print money and do what needs to be done, especially when it pertains to banks? Absolutely. They offset 2/3 of what they had worked on. That's dovish, you know. So the U.S. dollar is pricing in some of that, and that's another factor. Is you have to say, well, the U.S. dollar is already down a lot going into this announcement. Is it already pricing in some of those factors? So do I want to fade it? If the dollar sells off, it's already priced in a lot of dovishness. Do I want to fade? Meaning, do I want to try to buy it as though that's kind of the exhaustion low on Friday, and that might be a possibility. So I don't have a strong inkling yet as to how I'm going to trade the US dollar. I'm just kind of exploring those thoughts, but I always try to think through how the market is positioned, what the sentiment is, because ultimately I've got to figure out some of where the market's maybe not positioned correctly and some of where there's overreactions or underappreciation. And if I can do that, I put myself in a better spot to trade these currency pairs effectively. It's kind of like we did on Monday night where we said, look, the Aussie, that what they're doing and what their recent inflation numbers have been coming in as disinflationary and such, they're not likely to raise rates, and they might even have a dovish message. And I really wanted to be short Aussie into that announcement. And so I like the setup against the US dollar. And I think we can look at some of those things going into this payrolls number. So I hope that's helpful. Yes, happy to look at it. So a request for Euro USD. Let's pull that up here. Did I go past it? There we are. Euro USD. So here's the daily chart. Little bit of a reversal. And if we just look at the big picture of Euro USD, well, Euro's stronger than US dollar, no doubt about that. Perhaps in the process of sort of cup and handle, right? Now, if it was going to be perfect, it would have gone just a little bit higher here. That would have been picturesque. In fact, just a little higher here, I would usually be inclined to maybe bet on it coming down and creating that handle. The top is at about 110 on Euro USD. The bottom down here is at about 105. We could be more precise, but it's basically 105.20. That's the size of this big cup that it's been building for months now. So the difference in those, if we look at peak to valley, in a cup and handle pattern, remember how you do it. You take the size of the cup, and the handle is usually about 30% of the size of the cup, right? So 110 minus 105.20, and this is not an exact science. This is just gets you really in the right frame of mind. So 480 pips. That's how big this cup is. So the handle should be about 30% the size of that. Well, what's that times 30? 144 pips. So 144 pips right here. So we go down basically from 110. We should go down that amount. So we'd be hitting 108.56. And I drew it pretty darn good. I drew the handle at about 108.56. I draw these enough that I'm pretty good at eyeballing them. At about 108.56 is basically where the handle should be. Again, it's not perfect. I really wish you'd have been up there and then started kind of that walk back for a few days or maybe even a week or so. But if you get a setup right around there, it's a compelling buy area right at about that 108.56, because if this is a cup and handle, this is usually a good place to buy the dip anyway. As you get back up to 110, that's 100 and some odd pips of profit just there. And then the third time you get up here, remember this is where it establishes the major resistance. This is where it retests the resistance. The third time should be the charm. This is where it breaks through the resistance. Thus the cup, the big cup, shallow handle, and the big breakout. So kind of interesting from that standpoint. I would be inclined, had it been up at 110 and touched there and coming down, then I would really like the chart setup. It may just be kind of creating that pattern and not be picturesque. I'm just glancing through the different time frames to give you any other insights that I see, but I don't think I really see any. You'd just from a charting perspective, it's more bearish of late. So if you get a rally here in Euro USD, you're probably looking at short setups. And that might be tomorrow, that might even be into Friday, where Euro USD is looking like short the rally right now in the shorter term. So push back up there would give you a short setup right underneath these moving averages, right up there at 109.25 or so. So for the rest of this week, we've still got stuff on tap. We've got on Thursday our currency recap that'll come out on Friday morning. This is 6:15 a.m. Mountain Time, 8:15 a.m. Eastern Time. We'll be trading the payrolls live. And then, as always, we'll get the currency trading room out this weekend. So join us on Friday morning for that payrolls report and have a great rest of your week. Thanks, everyone. We'll see you next time. Goodbye.